the Midas Investor Series with Scott Sandell. I'm Jonathan Turk, Stanford class of 86 in economics, University of Chicago MBA 91, I think. Here with Sheila Proeve and Scott Sandell today. Thank you for joining Stanford Angels and Entrepreneurs United. We unite the Stanford startup community and innovation centers across the country beyond California with regular remote programming. The format today will start with a fireside to get to know Scott, followed by a short live Q&A. Next, Scott will share his first impression on 3-minute pitches from some founders here. Note, today's event is for educational purposes only and should not be construed as investment advice nor endorsement. Welcome today's speaker, Scott Sandell. Scott is managing general partner of NEA. Since joining the firm in 1996, Scott has led investments in many industry transforming tech companies, including Data Domain, Salesforce.com, Tableau Software, WebEx, and Workday. He's among the most frequently named venture capitalists to the Forbes Midas List. Scott is currently the lead independent director of Cloudflare, Bloom Energy, Coursera, and Robinhood, among others. At the National Venture Capital Association, Scott served as chairman of the board from 2014 to 2015 and founded Venture Forward, a nonprofit strengthening areas key to the future of venture capital: education, history, diversity, inclusion, research, and data. In 2019, he was awarded the NVCA Outstanding Service Award. Scott is also an adjunct lecturer in Stanford's Department of Management Science and Engineering. He also previously served on the board of advisors of the Thayer School of Engineering at Dartmouth. Before NEA, Scott was a product manager at Microsoft. Prior to that, he co-founded the European subsidiary of Tableau Software. He began his career at the Boston Consulting Group. Scott holds an MBA from Stanford and an AB in Engineering Sciences from Dartmouth. Now I'll hand it off to fellow board member Sheila for a discussion with Scott. Thank you.
Thanks very much, Jonathan. I'm Sheila Proeve, MS in Computer Science from Stanford and a co-president of Stanford Angels and Entrepreneurs United. We're delighted to welcome renowned investor Scott Sandell. Our community would like to learn a bit more about you, Scott, and how you think. We received several questions in anticipation. Let's start with your investor's perspective. How has your approach to investing evolved over the years? What are the top lessons you've learned?
Well, first of all, thank you guys for having me. It's great to be here and to be with so many other Stanford alums. I started investing when I joined NEA in 1996. And I think among the things that were different, I think the times were a little bit different then, but I remember when I was just starting out, I was basically looking for safe investments. I figured, no one told me this, but I sort of figured that they were going to allow me to invest about $10 million. And if I could turn that into $40 million, I probably got to keep my job. I later learned, many years later, that that's probably the way they were thinking about it, although they might not have been sort of as crisp in their own minds as to that framework for evaluating my performance. But as I was saying, I looked for things that I thought were sure to make 2 or 3 times my money. And I did that for probably the first 5 years of my career, which was from 96 to say 2001. And what I came to realize, fortunately, a lot of the early investments worked out well. But when everything crashed, in 2000, 1999, 2000, I was able to sort of see, it's the Warren Buffett expression, no one knows who's wearing a bathing suit until, the tide goes out. And I think I had 10 portfolio companies at that point, and I figured out that some of them were made really differently than others. And from that point forward, I started thinking about it differently because I realized, first of all, that the companies that I thought were safe bets were generally not anywhere near as safe as I thought they were. We always have to make decisions relatively quickly in the venture capital business. And of course, there's a lot of unknowns, in early stage investing. And the combination of those things means that there's really more risk than you think there is. So if you accept that as a sort of assumption in your calculus, then you ask yourself, well, what's the logical thing to do in response to that? And this is probably obvious, but the obvious thing to do is that you have to take more risk. You have to go after things that you know are really risky, but which on the other side could be, home runs, because the venture business is actually driven by home runs. Something like 5% of the capital produces 95% of the returns, or even more dramatic than that. So it's a really bizarre business from that standpoint. But it just means, and I'm always encouraging our team, that we need to look for those things that could be home runs, and we need to be prepared to take a lot of risk at the beginning.
What startup traits impress you the most?
We look for people who are exceptional, and usually, they have a track record of being exceptional throughout their life, because those are the sort of people who can do the exceptional thing, which is to create a successful company. I think beyond the sort of obvious stuff about what makes somebody exceptional, we're also looking for people who are really focused on building a big business, that they're sort of mission driven. They're not in it just to make money. The reason for that, with the benefit of hindsight, is that if the only reason you're doing this is to make money, there are better ways to make money than starting a company. Starting a company is just much too hard. So the people who are only in it for the money tend to give up. The people who are in it because they're trying to fix some problem or make the world better in some way, those people persevere through the hardships and come out, favorably on the other side.
What kind of companies should seek venture capital funding? And what are the signs that founders may be pursuing more a startup lifestyle company versus pushing hard for investor returns?
Well, I actually think this is a really important question, because if you think about what I've already said, venture capital is not for everybody. If venture capitalists are looking for these home run opportunities, which I think most of them are, although I think few truly take the kinds of risks that it takes to fund those potentially game-changing companies early on. But leaving that aside for a second, if you're an entrepreneur, you don't want to be, taking money from a venture capitalist who has those kind of expectations. And certainly, if what you want to do is create a lifestyle business, then it's not going to work at all, because the alignment of interest isn't there. What you want is to find investors who have the same goals and motivations that you have. And there might be, there are lots of other kinds of investors in the world. And if, maybe you're going to create a lifestyle business that generates really nice cash flows, and that might fit really well in somebody else's portfolio, but it's not what the venture capitalists are looking for.
Now for your thoughts on current trends. How has investing changed post-COVID? Does geography matter?
I mean, I think the answer to that is it sort of doesn't anymore. But that wasn't obvious at the beginning. There was sort of an interesting early phase, call it the spring of 2020, when all venture capitalists were sort of scratching their head and hemming and hawing about whether they were going to make an investment decision to fund people they'd never met before. And then everybody kind of got over that. And then there was the question of whether you were going to be able to hire people without ever meeting them in person. And people kind of got over that too. And then there was the big question for the venture capitalists, which was, would the limited partners fund a new venture capital fund without meeting, the general partners? And they got over that too. So, maybe obvious to everybody at this point, but it is pretty remarkable what sorts of things transact over Zoom. And in my own experience, now that we're, seeing people a little bit more often than we were, one of the things that's most striking to me is, for example, I interviewed a CEO candidate for one of our companies a couple of weeks ago, and then I had a chance to meet him in person. And at the end of the in-person meeting, we were both sort of comparing notes and saying, what did we miss, on Zoom that we picked up when we were meeting in person? And both of us thought the answer was not very much. That Zoom in a setting as small as the one that the three of us are on is actually intimate enough to get most of what you need to know. And so, the consequence of that, which I have to say I didn't really see coming until it sort of arrived, was that all of the efficiencies of Zoom people suddenly capitalized on in the venture business. So as an example of that, Europe used to be, someplace that a small number of U.S. venture capital firms would visit and invest in. The valuations were generally lower because there was less competition. There were fewer local firms, all those kind of things. Europe was disconnected from the U.S. market. Not anymore. With Zoom, every company in Europe could raise money from anybody on Sandell Road, in the same way we're having this conversation. And that's what started to happen. And then, the time frame to make a decision started to accelerate. So if, in the pre-COVID days, you might expect to have a couple of weeks to make a decision on a company that you meet, that got compressed. And now sometimes decisions some firms are making decisions in a few days. Some firms make a decision in 24 hours. So it's changed the nature of the business.
Now, tech equities have been down 50 to 80% off all-time highs. How will the public market decline impact early funding rounds? And have you seen changes to limited partner sentiment?
Well, Sheila, one of the things that there aren't all that many benefits to getting older, I guess, but I've lived through a few cycles, and the same thing happens every time, which is that when the public markets trade off that much and stay down, the private markets will follow. But unlike the public markets, which can adjust in a minute or 5 minutes or a day, the private markets have a whole bunch of structural reasons why they adjust slowly. But I would say on average, it takes about 6 to 9 months for private market valuations to catch up with changes in the public market.
Along those lines, are you seeing fewer seed and Series A term sheets? How has the velocity been impacted?
Well, I think we're still in the early part of the correction in the private markets. So the velocity is still pretty high. And people like me have been around a while are telling all of our companies to go raise money now instead of waiting 6 months if that was their original plan. So there's plenty of velocity in the business.
What are your thoughts on crossover funds such as Tiger Global that are pushing into venture capital? Does this look permanent or temporary to you?
Time will tell. It's certainly possible that they adjust to the requirements, if you will, of the venture capital business. But they're fairly untested at this point. They have made a lot of investments almost indiscriminately. They haven't lived through a downturn. So I think the big test is whether their investment returns are durable through a downturn. If they are, then they get to stay and play for a while longer. If they're not, they probably can't raise money to do it again. But it's entirely possible that they're here to stay. We'll see. I think it's really dependent on how successful their existing investments are. We saw this. To be honest with you, it reminds me of SoftBank. SoftBank proved to all of us that if you show up with a big checkbook, people will take a meeting. And if you're willing to pay a higher price than everybody else, you can win the deal if you pay a high enough price. And then the question is that a successful investment strategy?
One more question before the live Q&A. How might blockchain and token technology impact the VC industry?
The entire crypto blockchain, phenomena has become one of the best places to invest capital for venture capitalists. So in that sense, it's already very important. I think the question is sort of getting at how will it affect the practice of venture capital itself? And in that regard, I think probably the most interesting thing is whether distributed organizations, DAOs, will become a form of venture capital firm in which the capital that's invested may be, a cryptocurrency, and the style of decision making would be organized in the format of a DAO. We haven't seen that really yet that I'm aware of, at least at any reasonable scale. But it's certainly the thing that's interesting in the back of my mind. And then, there's tactical things. I think the blockchain can be applied to lots of different stuff. And it's possible that it makes, I don't know, the relationship we have with our limited partners could become simplified by having everything on a blockchain, for example. Who knows? But I don't think that stuff that sort of maybe makes our business a little more efficient. I think the bigger change would come about if cryptocurrencies became the de facto currency of investment, and DAOs became the form of organization that successfully deploys the capital.
Well, thanks so much, Scott. Now we are moving to the live Q&A. What sectors does NEA find attractive right now?
Well, for those of you who don't know NEA, we're a multi-stage global firm. We invest in healthcare technology, information technology, broadly defined, which is both consumer and enterprise technology. So it really depends which part of the business you're talking about. If you were talking to my biotech partners, they would have, a whole set of investment theses that are entirely different than, my consumer internet partners, for example. But I think if you step back from it, venture capital is driven by big technological changes. The cost of sequencing the human genome has come down orders and orders of magnitude in the last 2 decades and is starting to impact drug development. So is the application of information technology to the development of new drugs. There's also, of course, how information technology is impacting healthcare itself and delivery of healthcare, which is everything from telemedicine to, better record keeping, better application of data science to treatments. So, for example, since this may sound like gibberish to most of you, we have a company called Tempus Labs that we were fortunate enough to get into very early. It was created by one of our entrepreneurs whose wife had breast cancer, and he was sort of appalled at how little information was used to diagnose and treat her. And so he quickly imagined that if you were able to collect all the information on all of the cases of oncology cases, worldwide or in the US, and you were able to pair that with the genomic and phenotypic data from a patient, you might be able to come up with more effective treatments, more personalized medicine. So what Tempus now allows a doctor to do is, put in your genomic information, your phenotypic data, which is, other characteristics about you, and see what treatments have been applied to patients like you. And the reality is that you get much better outcomes when you know that much more about individual patients. So that's an example. If you go to the information technology business, the internet has changed everything. I mean, if you go back to when I started at NEA to today, so many things have changed. I think the physics of starting information technology businesses in almost every way have been changed. Whether that's, what it takes to develop new software. Software developers today are 5 times more productive than they were in 1996. Doesn't mean they're 5 times smarter, but people building software today have tremendous libraries of open source technology that they're able to stitch together into powerful new products in a way that wasn't available in 1996. Of course, software distribution is completely different. We used to think of an enterprise software company as a business in which you hired a bunch of people in suits and they went out and made office calls and made presentations, and eventually you sold software, and years later it was implemented and customized. Now we have product-led companies which release maybe an open source product and give away something of real value for free. Customers are able to try it out, use it, change it if they want to, and those same companies then come along and offer them either support for that software, or more often proprietary software they develop, which is helpful to the customers who are using the open source product. These are the kinds of business models which have evolved in the last 25 years that didn't exist before. So in addition to everything happening in crypto, there's a lot of other very fundamental stuff that continues to be really interesting. I mean, you can't have a conversation like this and not talk about machine learning and artificial intelligence. We're still in the pretty early innings of that, where there are some, very successful applications in lots of places that haven't figured it out yet, but will in the decade to come.
Would you expect the funding levels to remain the same as the previous highs, or do you think there's going to be an impact down the road? In what way?
Oh, I think there's a lot of dry powder in the system because a lot of firms have raised a lot of capital in the last few years. So, that will get invested over a period of time. And it'll probably take a couple of years before we see whether limited partners want to invest that same level of capital again. My guess is it'll go down. It's a cyclical business, and we've just seen a tremendous cycle, that lasted over a decade.
So do you have any predictions on the vintage 2021 or 2022 funds?
I think fresh capital deployed today, a fund starting in 2022, I think could be very, very successful. I wouldn't invest it all in the first 10 minutes, because as I said, I think the markets will come down. Private market valuations will come down. But one of the things that, we have seen in downturns is that the kinds of entrepreneurs who come out in a downturn and start companies are usually pretty spectacular because, bad economic times scare off the sort of tourist entrepreneurs pretty quickly. And so the people who come out really know what they're doing. They're usually, driven to solve a problem, like I was saying earlier, mission driven. And often they're more experienced.
Why recent IPOs have performed quite poorly?
Well, here again, Sheila, it's a cycle, right? What happens in the public markets is that, there's a collapse in valuations. All the investors who invested in an IPO lose money. So, when they decide they don't want to try the next IPO or the one after that. And so then the requirements to take your company public go up. So if you could take your company public with, say, $100 million of trailing revenue last year, next year you might have to, build your company up to 200 million in revenue, and maybe it has to be profitable. And so in the beginning of a new cycle, the requirements have become very high. Companies have matured to the point where they meet those requirements. They're generally priced very attractively to entice public market investors to jump off the iceberg and start investing in new IPOs again. They're priced to go up so that the first investors are successful, so they come back for more. The cycle starts to build. And, then in the later stages of a IPO cycle, the less attractive companies try to go public, and some of them are successful, and the valuations keep going up and up and up until they don't. And then the cycle starts over again.
How do you think about social good versus returns when you look at the mission of a company?
Well, I think it's a balance, but what I said a few minutes ago, I really believe, which is that especially in the world we live in today, the people who are starting a company to solve a real world problem, to make the world better, tend to be, more persistent through hard times. They tend to be able to attract similar people to their businesses. And, oftentimes they build better businesses as a result of that, because, people are very motivated, to try to make the world better. And there are lots of examples of that having been done by startups. So it's sort of a perpetual cycle.
Now, how does NEA decide which industries to focus on or whether to consider an entirely new industry or sector?
Well, one of the things that's true over the long arc of a venture capital career is that, things change. What's interesting changes. The entire sectors of the industry go away and other ones sprout up along the way. And so you always have to have an eye to the thing that's, a little bit off stage, a little off the fairway, and see where new opportunities are coming from. And so if you're a large venture firm like NEA, you want to get in early on these new trends, but generally speaking, you stick your toe in the water before you back up the truck on any of those sectors or investments. So as an example, many years ago, we started investing in clean technology, and we were in early, and we were one of the bigger investors in that space. It didn't work out very well for us, but because we're a large fund, we did have some winners, by the way, but because we're a large fund, it never amounted to a big enough percentage of any one of our funds to dampen returns. On the other hand, we started investing in China early, and that worked out, really well. So we will, take risks where we see opportunity, and then, we say crawl, walk, run. So we start off a little bit, and then when it starts to work, we get more serious about it.
So on new areas for investment, we have quite a few questions in the blockchain realm. So first, what's your definition of Web3, and what areas does NEA see as ripe for disruption?
Well, I think Web3 is kind of a catch-all phrase that encompasses everything from cryptocurrency to applications of the blockchain to just about anything. We as a firm don't invest in cryptocurrencies directly, but sometimes we end up with some cryptocurrency returns as a result of investment in companies. What I personally find, I have partners who find all kinds of things exciting and interesting. NFTs are one of the latest crazes, and we have some investments in that area. I personally haven't gotten too excited about NFTs yet. But what does excite me, and which is probably not the thing of interest to most people, but I think the blockchain is going to be applied to disrupting traditional finance in extraordinary ways, and we're already seeing some of that. So it'll apply to lots of other industries too, but I just think the financial industry in general is really ripe for disruption.
So on the topic of NFTs, do you think there's a lot of hoopla around it, or do you think they're a serious form of ownership?
I think they're going up a lot in value, and we'll see if it lasts. A little bit like the tulip craze to me, but perhaps I'm just too old to appreciate it.
Do you foresee new DAO investment structures affecting returns? Will the multiple in gains probably not be the new standard for Web3?
I don't know. I mean, I think the laws of supply and demand will prevail. If there's too much capital that goes in and not enough opportunity, returns will go down. If the right amount of capital meets the right amount of opportunity, the returns will probably be pretty attractive.
What are the most important factors to NEA when you make a new investment? And how do those vary across the stage of the company, whether it's an early stage or perhaps a growth stage?
Well, for us, the people are the most important thing. You can take a great entrepreneur and give them a lousy opportunity and it won't work. But if you take somebody who's not really up to the task and you give them a great opportunity, you very often stub your toe and you lose that opportunity. And we don't invest in competing companies, so we really like to find the best team that's going after a given sector and invest in that team because we think they'll have the best chance of winning. And then it's a question of picking the right sectors and the right technologies and so forth. In terms of stage, obviously things do change in terms of what you're looking for. At the beginning, at the very earliest stage, it's 100% about the people. And then they create a product and you get to look at the product or the technology and make some assessment of that. Eventually, hopefully they have product market fit and you can see what sorts of value a new product or technology is delivering to the customers. So that's another value creation moment. Then you start to see whether the organization can figure out a go-to-market strategy that allows them to take over the market. By the way, that strategy might be offer the product for free and figure out how to monetize with a later product or some variation of that theme. Or it might be that you're going to sell the product and see how quickly you can grow revenues. But ultimately, you have the ability to look at the financial characteristics of the company. Is the company able to charge prices that result in high margins for whatever it is they've created? We love high margin businesses because margins are an indication of the uniqueness of a product, the value that it's creating for the customer. And by the way, high margin businesses require a whole lot less capital to scale. which tends to, result in higher returns for the investors. So, as you move from startup to, the public markets and beyond, you definitely look for different things along the way.
Now, some venture funds are keeping companies in their portfolio even after they've gone public. What do you think about this trend?
Well, we've been doing that for a long time, so I don't think it's new, but I think it's hard because you have to be right. When you have a portfolio of private companies, first of all, they're not marked to market every day. And secondly, your limited partners really don't know that much about them other than what you tell them about the companies. And of course, we're very transparent about our companies, but it's quite different when the company's publicly traded and all of your limited partners are watching, the company's stock price every day. So as I said, if you want to hold well past, the lockup periods, you have to be right. We've had some great successes and some pretty big mistakes in that regard.
It seems more institutional investors are moving to invest in seed rounds or Series A directly. Do you think it's a function of more liquidity, or is it because they're seeing excessive valuations at the later stage?
Sheila, do you mean that the limited partners are investing in the companies directly? Is that
Yes. There are often sidecar deals.
Yeah, no, that's very much a trend. I think it's fairly simple. The limited partners would like to lower the price of deploying capital into the venture capital business. So, they have to pay fees and carried interest to the venture capitalists. If they invest directly in the companies, they don't pay that. So consequently, they're always looking for opportunities to co-invest alongside the funds that they invest in. And, the funds are always trying to help their limited partners. So very often they create those opportunities.
What traits do you think make someone a successful VC? And what advice would you give someone who is interested in pursuing a career in this space?
I think a little bit like what I said about entrepreneurs. I think if you're just interested in making money, there are a lot easier ways to make money. I think it's a really hard career, contrary to what people might think from the outside. I'll give you some, math to think through what it takes to be a successful venture capitalist. At one point in time, this math was true. It's probably a little different today, but it's directionally correct. At the time I collected these numbers, there were 10,000 individual venture capitalists in the United States. And every year, the industry invested in 1,200 new companies. And at that time, about 50 of them would go public in a given year. And of the 50, maybe 10 or 15 were home runs. And once every 5 years, one of them was a phenomenal home run. So just think about, how competitive an industry it is. If you're one of the 10,000 people who's trying to invest in one of the companies that goes public, and maybe there's 100 more that are successfully acquired for a good return. First of all, it's more than 5 to 1 just to, win a deal and be able to invest. And then, 5% of them work out really well, or 10% or some number like that. So it's, and if you want to be in the business long term, you have to be able to do that over and over again. So it's a very difficult job, and I wouldn't wish it on somebody who wasn't, deeply excited about helping entrepreneurs build great businesses, sort of shoulder to shoulder with them. Somebody who isn't incredibly curious and always interested in learning about new things. Somebody who isn't really, really patient. Probably have to have some pretty good people skills along the way to get along with entrepreneurs who, by the way, are often, a little bit quirky. I think it's helpful to have a relatively low ego. Should leave the ego to the entrepreneurs, make them the heroes. So those are a few things to think about.
Scott, if you were starting a business today, where would you focus your energy?
If it's specifically me, or sort of as a general statement, I think as a general statement, I would focus on something you feel you have, sort of a special advantage in knowing about. So I would look at what the big industry trends are, but if your background is in biotechnology, it might make a lot less sense to invest in a new data science company unless the data science company was being applied to biotechnology. So I think you need to have sort of an unfair advantage at the start. I'm not a big believer that people should just sit around and decide they're going to start a company and then come up with an idea. I tried to do that myself once, by the way, and had a couple of ideas. And what I found, this is before I went to NEA, between Microsoft and NEA, I found that the people who were really knowledgeable were already 6 to 12 months ahead of me by the time I had identified something. On the other hand, where we see people very often sort of coming up with a great idea is when they're dealing with the problem themselves. They are the customer, or they know the customer and they know the customer's problem. That's just a huge advantage because it helps you figure out what to build. It helps you achieve product market fit. It helps you, have a vision for where the product needs to go. So that would be, I think, the most important advice. And then I would, encourage whoever it is to learn a little bit about how challenging it is to really start a company, because we seem to only read about the big rosy successes and most startups fail. So, I want to be fairly, understand a little bit what you're getting into.
Thanks, Scott. Now we'll move to your first impressions. And first up, we have Jeffrey Chang.
Hey, Jeffrey.
Hi, everybody. How's it going?
Good. How are you?
Good. So I'll get started. So where would Dr. Frankenstein be without Igor? Or where would Bunsen Honeydew be without Beaker from the Sesame Street? So every scientist needs an assistant. And that's why we at Robot Bacon are developing a virtual assistant to help the modern biologists do their science. So my name is Jeffrey Chang. I'm a research scientist with a background in cancer biology as well as data science. And for almost 2 decades now, I've been working with biologists. And throughout that time, biology has advanced from a discipline that's used in pipettes and petri dishes to one that's really analyzing genomes with supercomputers. And the problem is only 7% of the biologists really have the skills to do that kind of research. So that's why in my lab, we've been developing software that can help biologists do those kinds of analyses. And our approach is that we use artificial intelligence that can figure out how to process and mine the data to answer a biology question. So for example, if somebody asks, is my gene mutated in cancer? Or does my gene have high expression in cardiovascular disease? We can figure out how to get the researcher the answers to those questions. So we've been using the system to help the research in my lab and in the labs of my collaborators. And at this point, I would like to try to bring it to a larger audience. So what we're looking for is funding and people to help us to turn this prototype into a minimally viable product. And then also we're interested in talking to people that has an understanding that can help us with some directions on how to move forward. So I'm looking forward to talking to everybody, and thank you very much for your time.
Well, Jeffrey, thank you for sharing what you're doing. I think you're actually a really good example of what I was just talking about a minute ago. You're somebody who's living with the problem. You know exactly what the problem is. And that gives you this huge advantage. You've built a system to solve a problem you have, and you see other people around you have the same problem. So I think that's really great. Obviously, drug development in particular is enormously expensive. And the application of information technology to make scientists more productive is probably one of the higher productivity applications that you could imagine in the world today. So it sounds really interesting. You already have, it sounds like, a prototype, and you need to, turn that into a minimum viable product. Probably not hugely capital intensive before you have the opportunity to see whether people will pay money for it and whether it will really deliver the kind of value that that you would anticipate. There's, I think in the course of due diligence, things that people would probably wonder about would be, how complete the product is today, or whether, the product only answers a small fraction of the kinds of questions that the biologist might have. Whether it needs to be maybe tailored, in order to be a complete solution, maybe it has to be tailored only at oncology or, some other area of interest. So you'd want to understand those kinds of things. And then it sounds like, your background is in science. So there'll probably be some questions about whether it would be helpful for you to have a business partner who could help you build the company, assuming that wasn't your personal motivation. But I think you should definitely pursue what you're doing, and I'd be more than happy to connect you to some of my partners on the medical side who would be able to be helpful to you much more than I could be.
Thanks a lot. Yeah, you're very sharp. You hit everything that was thought might come up.
Well, Jeff, my email is easy. My first initial S for Scott, and then my last name, Sandell, Sandell @NEA.com.
Right.
So I'll look for something from you, Jeff, and I'll connect you to some folks.
Fantastic. Thanks so much.
Thank you.
Thank you, Jeff. Now we have Bob Siedman.
Hi, Scott and Sheila and Jonathan and everybody else. Thanks for putting me on. I actually wasn't prepared. I was listening and interested, and I thought I'll give this a shot. So I'll tell you about my startup. So first of all, do you play poker, Scott?
Not very well, Jeff, or sorry, Bob.
But you play. I mean, if you had any social games, for example, friends hanging around, having beer.
Oh yeah. No, I've played enough poker to know how it goes.
Okay. So let me tell you that I've started a number of tech companies. I was in Silicon Valley until about 3 years ago. I became really interested in poker, and as part of that, moved to Las Vegas about 3 years ago. And what I started watching poker on TV. I started playing in major tournaments. My background is electrical engineering and software, by the way, and software forensics. But I started playing in tournaments, and I wondered why, it'd be great if I could put together a system where people can talk to each other and talk to an audience. I don't know if you know, but poker is actually one of the biggest, if not the biggest, sports broadcast. It's bigger than, because I think it goes on year round, and you can watch anytime. So during the pandemic, I realized how to do this, and I applied for a couple of patents, hired a software development team, architected the system, and we're ready to go public. We're ready to launch really soon. We're in alpha testing right now. But basically what we've done is we've done online poker, which is a huge and growing industry if you know about it. And this can be applied to other games, not just poker. But what we've done is we've added audio and video, which turns out to be really difficult to get that all coordinated and synced. And I'll tell you, our patent pending technology, other people have tried to do that. They're kind of doing it and struggling a bit. We've been testing our system and getting great feedback. In fact, nobody has said anything negative. They do have some features they want to add to it. But one of the advantages we're going to be able to have is to broadcast games where people can actually talk to the audience and hide their comments from the other players. And so the big thing what made poker become a big televised sport was the camera in the table where you'd see people's cards. And then the next big thing that happened is when they broadcast them, they'd have announcers saying what people were doing and basically second guessing the players. Well, they're gonna shove, they're gonna fold, they think the other player's guess is bluffing. But the problem is you're hearing that second hand. We have the ability to make that first hand. So we can actually have the players say, I think the other player is bluffing, so I'm gonna call his bluff. So there's two advantages to our system is one, well, initially the idea was to have these broadcasts where players can talk to the audience. And I found out from broadcasters, I've been speaking to them, that's something they've been trying to get players to do, but they're afraid about letting the other players at the table hear what they're saying. And the other thing is what we think is even a bigger market is the friendly games that you just can't have online right now. Again, we've been having these friendly games with audio and video, and it gives people a chance to have a social experience as opposed to just a betting experience.
Well, I like it, Bob. I think you're probably onto something. Here again, you know the problem space because you're the customer. It's always helpful to start as a customer. I'm reminded of a Monday about 3 or 4 years ago, when my partner Rick Yang, who runs our consumer investing practice and who I'm happy to put you in touch with, he came in. I forget exactly the circumstances. Basically, there was an e-gaming event over the weekend, and some 16-year-old kid had won like $5 million or $10 million or some sizable amount of money. And so the question that everybody was asked was, how many people watched this e-game? I don't remember what it was. And the same weekend was the US Open tennis tournament. And the question was, how many people watched the US Open tennis tournament? How many watched this e-game? The answer was that there were about 1.5 million people who watched the US Open on television and 30 million people who had watched the e-game.
Yeah.
So, you're moving into a field where there's obviously enormous appeal to online participation. And it sounds like you've unlocked a couple of key features which could really increase, audience engagement significantly. And you have, it sounds like, patents to protect those things, which are probably really important. How you launch it, how you market it, those are all important things to figure out. But it's, I don't know enough about poker, or I'm not interested enough personally to be the target audience here. But I think, you should talk to people who are experts in the gaming business, and we have a few of them in our shop. So send me an email and I'll put you in touch with them.
Okay, I will. Thank you very much.
Thank you, Bob.
Thank you, Scott, for sharing your first impressions with Jeff and Bob today. Thanks also for your insights. A final question for you. What's your parting advice for founders striving for their first sizable check?
Well, I think one thing that is sort of an old expression in the venture business: if you're looking for money, ask for advice. If you're looking for advice, ask for money. So what does that mean? It means that, seek out people who could be helpful to you, and genuinely be looking, for their advice. And you're more likely, if you interest them, to have them shift the conversation to investing money, especially at the very beginning where you're probably looking for friends and family kinds of money. Also look for people who really, really understand what you're doing. There's no substitute for that. It's like with Bob's idea, if he can find an investor who really understands poker, he's way ahead of the game. If Jeff can find an investor who really understands drug discovery and software and the problem that Jeff described, he's way ahead of the game. That conversation is a much richer conversation for either of them than if they're, talking to somebody who doesn't have the foggiest idea. If you take Jeff's company as an example, imagine Jeff trying to convince somebody who, might not even know what the word oncology means, or doesn't understand any of the trends in drug development today. It's just a much harder way to go. So find people who are really knowledgeable about what you're doing. And then the last thing I would just say is be really careful who you pick, because you're stuck with them. Once somebody gets on your cap table, you can't get rid of them. And, investors can be wonderful and they can be terrible. And so do your homework and figure out, who you're dealing with and who you would really want to work with for a long time, because, to build a great company takes a long time.
Thanks very much, Scott, for joining us today. We appreciate your time and candor. I will hand it back to Jonathan for closing announcements.
Thanks for having me, Sheila.
Well, Scott, well, we thank you tremendously for spending this time with us. For those who might have missed it, can you restate your email address and the best ways to get in contact with you?
Absolutely, Jonathan. My email address is ssandell, so SSANDELL @NEA.com.
Fantastic. Well, thanks, Scott, for joining us today. Now for announcements. First, pitching the Stanford Angels. We're delighted to welcome last month's speaker, Sale Kwan, to our investment screening committee. Sale is a partner in the emerging companies and venture capital practice at Cooley LLP. If you or a startup founder you recommend is fundraising and would be interested in pitching to angel investors across chapters of Stanford Angels and Entrepreneurs in April, submit a business plan or pitch deck for consideration by our investment screening committee to our email. And please share your suggestions for future programming and topics you'd like to learn about either in the chat now or at our email, capital SAE United at alumni.stanford.edu. Thank you very much. And thanks again, Scott, for the wonderful presentation.
I'm going to sign off, but thank you guys for having me. And good luck to everybody.